Hello and welcome. My name is Nelson, and in this video I will cover the credit bureau in a fun way to look at how to not take advantage of the system, but play the system, and different things that affect your credit bureau score, how to improve your credit score, what is reported on your credit, how long things are reported on your credit. I'm going to avoid all the technical crap, okay? Before that, we're going to play a little game. Let's get started. So we have two options. Which one would you choose, okay? Option one is, would you take $1 million today, if I were to offer you $1 million? Or would you rather receive 1 penny today and receive double the value the following day for 30 days? So quick example, today I give you a penny, tomorrow I give you 2 pennies. So now you have 3 pennies. The next day I give you 4 pennies, because that's double of 2. The next day I give you 8 pennies, which is double of 4, okay? And you keep adding your pennies. So think for a second, which option would you take? Now, option one, assuming you didn't spend any of the money, on day 1 I give you $1 million. On day 30, you would have $1 million. Option 2, if I give you on day 1, 1 penny, and you keep doubling it, after 30 days, how much do you think you would end up with? Would you end up with more than $1 million if you didn't spend any of it? So on day 5, you would be given 16 cents. On day 25, you would be given 167,772 cents. Sorry, well, technically, yes. $167,772 would be the amount you'd be up to. On day 30, sorry, let me go back. On day 27, you would have $671,000 approximately. On day 29, you would have 1.3 million. And on day 30, you would have 2.6 million. So $2,684,354 on day 30. So option 2 is the winner. What does this have to do with your credit bureau? Nothing directly, to be completely blunt. However, credit bureau is a compounding factor, especially your credit score, I should say. Your credit score is a compounding factor. One event would multiply or divide, or I should say one event would drastically improve your credit score or drastically reduce your credit score. So credit score is a range from 300 to 900. So 300 is your minimum score, 900 is perfect score. How do you get there? I will show you. I've only seen one perfect score in my lifetime, and I've been in this business over 20 years. I know, I'm really young. I started when I was like 10. 300 score I've never seen. The lowest I've ever seen was 406. And this person had tons of late payments on their bureau and never claimed bankruptcy. Sometimes you're better off to claim bankruptcy or proposal and start fresh, because battling back from all these late payments is going to take a ton of time and you might be too buried. So that's the honest truth. So I've never seen a 300, which is the worst score. Now, this is a judgment or a snap in time. This score is a snap in time and a reflection of your financial health. Reflection of your financial health at a specific point in time. It's basically a look at the past 2 years of your credit score. So anything beyond 2 years doesn't really affect your credit score. So let's say you made a late payment 60 days past due on your credit card over 2 years ago, that would no longer affect your credit score, okay? But this score represents your risk to the lender. How likely are you to repay them when they lend you money? And so basically it's a comparison between yourself and other consumers. And based on trends, they gauge whether you are a likely candidate to pay well or not pay well. And based on that, they assess whether they're willing to take on the risk of having you as a customer or not. I'd like to now take this opportunity to go over the great inquiry myth, is what I like to call it. Tons of times I'm working with a customer, they're like, I don't want you to pull my bureau. And I say, why? So, well, I've pulled it a few times. I don't want the inquiry to affect my credit score. Well, to be honest, it barely even touches your credit score or affects it, because what lenders do is, for example, say you're looking for a car loan and you go to 10 different car dealerships and they pull your credit every time. In a 14-day period, those inquiries shrink and combine into one inquiry at the end of the 14-day period. They're expecting you to shop. Credit cards, on the other hand, you have to be careful with. But if you're applying for a mortgage, you can go to a different mortgage company every day in a 14-day period and have your bureaus pulled. And at the end of that 14-day mark, it collapses into one inquiry on the score as it affects your credit score. So the lenders might not like that you're shopping, but if you ever get declined because of too many inquiries, that's just lame, and you're working with the wrong person. So it actually used to be 14 days, but it's recently been updated to 45 days. So now in a 45-day period, you can apply for a different mortgage. And all of those inquiries shrink into one inquiry, and then your score adjusts accordingly to one inquiry, not 14. So when you ever thinking, oh, I don't want to pull my bureau because the inquiry is going to affect my credit score, not the case. What does drastically affect your credit score is not making payments on time and overutilizing your credit card. So if you have a $10,000 limit and you have an $11,000 balance, that's going to drastically shoot your credit score down. I'll quickly discuss what average credit score should be. You're aiming for being over 650. In a perfect world, your credit score should be 680 or higher. I love the 700 mark. 700 or higher, for whatever reason, I just love seeing it on a bureau. Customers usually get excited when they're over 700. But anytime you're over 680, that's the sweet spot. That's where you want to be. Because in another video, I went over your GDS, TDS requirements, and you get higher GDS and TDS limitations, which means you can qualify for a higher mortgage if your credit score is 680 or higher. Now, I'm going to go over a quick breakdown of what comprises your credit score. Okay? What affects your credit score? Payment history, the amount you owe, the length of your credit has been established, the amount of search and acquisition of your credit, and the type of credit even matters. But your credit score is weighed heavier in certain aspects than of the other. So I'm going to try to draw a big pie. My drawing is horrible, okay? So payment history. Is 35% of the weight of your credit score. So how well you pay your credit cards accounts for 35% of your credit score. And the amount owing counts for 30% of your credit score. So you'll see right there, over 65% of your score is based on your payment history, how well you pay your credit, and how much are you owing on your credit cards. So this section here is actually called utilization, okay? How much of your available credit are you using? So let's say you have a $10,000 limit and you owe $4,000 balance. So you have 40% utilization. In a perfect world, you want to be 20 to 30% of your limit. This strategy is the reason why if a credit card company offers me a credit card increase, credit card limit increase, I always take it. Because that reduces my utilization, which increases how much is available, which then increases my credit score. Never, ever, ever close your accounts, even though you're not using them. If you ever get letters saying if you don't use it in the next 20 days, we're canceling your card, always use that card to keep it open. And the reason is because of utilization. If you close out an account that you're not using, now your utilization percentage just went up because that's maybe a $10,000 credit card that's no longer available. So now your utilization percentage on all your other cards just went up in relation to what is available. So closing out an account actually drops your beacon score because your utilization just went up. People don't really know that, so they close their accounts. I've never ever closed an account. I keep them open. I just manage the amount of credit cards I use. So if I have 4 credit cards available, I keep 3 of them at a 0 balance and I use 1 if I need to. Or I just use them all, like keep them all at 0. Or I try to keep them as low as possible, so the 20 to 30% mark is where you want to be. Okay? 15% of your credit is based on length of time you've had your credit cards open. So again, if you have a credit card that's 10 years old and you close it, now your beacon score drops because the length of time you've had credit cards open, it just went down. So the longer you have a credit card, the higher your score. And then there's 2 other aspects here that equate for 10% of your credit score, which is search and acquisition. So again, the inquiries. So how credit hungry are you? And the last part is the type of credit. So this is type, and this is search. So this search and acquisition portion, don't forget, within a 45-day mark, it accounts for 1 inquiry. So if you're constantly looking for different types of credit, then that would hit your credit score by about 10%. But on 680, what's 10% on 680? And for type, it's a mix of how much of your credit score is personal loans, how much of it's credit cards, how much of it's line of credit. So revolving versus installment. Again, don't be too concerned with this because it's again only 10%. So 10% on 680 is what, maybe 20 points, something like that. So these 2 I would not be as concerned about, but these 3 are the big ones. I'd like to go over now how long items stay on your credit bureau. So inquiries stay on for 3 years. So if you've applied for a credit card, that means that's an inquiry on your bureau. After 3 years, that inquiry falls off. A judgment means if you failed to make a payment on something and you were sent to court and the court deemed that you owe that money, it is a judgment. That stays on your bureau 6 years from the date filed. So if you pay it, it will fall off. A lot of times if you don't pay it, the companies sell the judgments off to collection agencies and then they re-add the account to your file. But if you're not diligent, it'll stay longer, but it's 6 years from the date filed. Collections is the same thing. Collections are 6 years from the date of last payment. So when you make that payment on the collection, it stays for another 6 years. So you want to pay off you want to avoid collections altogether. But if you get them, you want to make that payment within 6 years. You want to pay it as soon as possible because in 6 years it will fall off. So if you wait 3 years to pay that collection and then it stays there for 6 years, you're now looking at 9 years of a collection staying on your bureau. So you want to pay that right away. A proposal under bankruptcy is basically a different form of a bankruptcy, and that remains on your bureau 3 years after your last payment is made. So when you pay that proposal in full, your proposal stays on your bureau for 3 years after that. You do not have to wait the 3 years to start reestablishing your credit. You can start reestablishing credit right away. And that's the same with bankruptcy. But bankruptcies stay on your bureau for 6 years after the date of discharge. A double bankruptcy stays 14 years from the date of the oldest bankruptcy. And secured loans are 6 years from the date filed, and a foreclosure on your house would be 6 years from the date filed as well. So double bankruptcy stays on your bureau for 14 years after discharge. A third bankruptcy stays on your bureau for life. And I believe the other 2 bankruptcies come back on your bureau so that it shows that there are 3 and it stays on your bureau for life. Hope you've enjoyed this video and I look forward to working with you.